Okay, this is a video where I'm putting together some of the issues with IRRs. And let me just introduce it a little bit. First, I'm in London. I don't know if I should say this. I'm very sad, of course, about it's just the time frame of these horrible things in Paris. Very sad. But now let me get emotional. IRR is the number that's used everywhere. And the reason IRR is used, because it's one number, and a bigger number is better. We all know that. And we don't have to look at things like NPV and the size of the project. NPV is a ridiculous pile of crap anyway. That won't work because we don't know what the WACC is and everything else. We don't have to measure the WACC, anything else. IRR seems to be the perfect number. And we get a higher IRR if we have more risk. So IRR seems to be perfect. Now, years ago, I tell my students this all the time. I got a wonderful question from a very, very nice lady. I wish I could remember, a lawyer in Malaysia, and she said, "What is this IRR business anyway?" And I said, "Well, of course, it's just the discount rate that makes the NPV equal 0. She looked at me and could have strangled me, and rightfully so. But this one number is what everybody in the world looks at, from lawyers to CEOs to everybody else, and are they thinking in the back of their mind, oh, this is the number that makes the discount rate that makes the NPV equal to 0? Of course not. But here, it's got so many problems as well. There's no alternative. I'm not suggesting there's really much of an alternative to the IRR, but we need to know its problems. And the biggest one, and I'm going to moan and complain about this Damaradan goddamn website where he puts the country risk premiums in there, and these country risk premiums are so high it amounts to stealing. It's stealing from countries in Africa. When you think you have to charge 20% return or something, and the 20% IRR in Africa versus 6% in Germany, you are stealing, period. Okay, and I'm going to prove that. And I'm going to go on and on. Now, here are some of my problems. Oh, sorry about getting so emotional. But I'm going to go through that a bunch and show you the real problems with it. Now, we're going to start with just mathematics. And then just demonstrate the effect of kind of compounding that makes these country risk premiums so outrageously criminal. And then talk about why, well, just a little bit of details, why XIRR, if you've got, a monthly and a semi-annual model, doesn't really work, but it's a minor thing. And then talk about how you can't really, the IRR doesn't account for development periods, which are crucial, and why the development periods don't work. And then it doesn't account for the very important and inherent fact of any project finance, that's the changing risk of the project, and the fact that the risk goes down over time, and the fact that the actual IRRs are much higher if you've got the high development IRR and can sell it early. And now the biggest thing, it doesn't, when you go long term, because of the compounding, because of the inherent little stuff in IRR, it overstates. You get an enormous probability of default when you put one of these high credit spreads, 5% credit spread or something, in IRR. And the biggest problem of all is this risk premium. And I'm sorry, I'm going to swear. There's no other thing to do about it. It just drives me nuts. These professors who put the stupid little some kind of standard deviation calculations and come up with some mishmash, and then people on Wall Street get a good excuse to charge all this number, make the American stock exchange go up so much while other countries fall apart. Sorry to be so dramatic about it. Now, here's the, oops. Oh, I haven't, just a second, just a minute. Okay, so I tried to put some of these issues in different pages. I haven't filled out this sheet yet. It's going to be called Issues with IRR. Perhaps we should press Shift F11, and then we should make a table of contents. Okay. Now, when you make a table of contents, if you use the shoot. I'll do it again. If you use the macro, now these things, it gives you names because they're functions. Okay. Control A, Control minus, and you go to table of contents, and it's a very simple macro. Okay. All right. Now the IRR mathematics I have done essentially. Let's do one more thing that I've done in other videos, but I'm going to remind you. So the first thing I do, I'm going to go through this real fast. If we take 100 and 120, 120 divided by 100 minus 1, that's the growth rate. And if we take IRR, and if there's nothing in between, it just is a one-year case. In the one-year case, the IRR is just the growth rate. So to answer this lady in Malaysia, the best answer is it's the growth rate. Now, if I take the compound growth rate, then I take the last number divided by the first number, raise it to the 1 divided by 2 power minus 1. And then you get the compound growth rate, which is not exactly half. And then you can take the IRR of this one. So if I wanted to do the compound growth rate, perhaps I'll do it over here. I would put, this is how my money has grown in 1 year, Shift Control 1, and then I take this one multiplied by 1 plus the growth rate in the second year, and I get that number. So this is the, maybe this is the accumulated cash or something. This is just the cash flow. Okay, so these are just cash flows, and that's our 2-year case. I'm not putting some stupid merge things. Please don't put merge things in there. Oh, you can, but it just messes up all the matching index stuff a lot. So now here's where the problem occurs. If I'm going to start with the IRR. Okay, so this is cash flow, you know, and I'm going to call this our growth, maybe. Okay, so this is a growth situation. Now this time we start with the IRR. So, and notice that when you, oops, oh, I guess that didn't hurt. The IRR is in between. Take that out, just if you get mad at me. The IRR is in between the 9 and the 20. It's a little bit closer. It would be 15 if it was right in between, so it's a little bit closer to the 9 because we have to wait. Now if we do this by hand, we put to do this by hand, we say, okay, let's take the last year cash flow plus the cash flow in the middle and multiply that by 1 plus the IRR. And that little thing you do right here, that's the end year. And you take the end year and then you divide that by the beginning year. Okay. And then you raise that whole thing to the, where did I divide it? I thought I divided it. And you raise that to the, okay, let me start again. I'm sorry. This one plus this one times 1 plus the IRR. That's the end. Okay, shift control 1 for now. Okay, and you take that end and you divide it by the beginning. And then you raise that to the power of the 1/2, put minus 1. And again, L8. Yeah, okay. Okay, what did I do wrong? Okay, shit. One more time. Fuck. Okay, I've done this only about 1,000,000 times. This plus this times 1 plus the 15.07. Okay, that gives me 127. That's my ending value. I take this ending value, maybe I divide it by the beginning value. That gives me 1.28. And I take this whole thing, maybe I didn't have enough brackets, I raise it to the 1/2 power and put minus 1. And then I get my number. Okay, you can do this with multiple cash flows. You then always have to essentially take these cash flows and make them into a forward value. You have to just put a forward value to the IRR. Okay, now that's the biggest problem with the IRR, because I made another extreme example. Here we have 200. If we have 200 in the second year, well, the IRR is 126%, and we're assuming with the IRR that you can earn on that second value 100%. How ridiculous. 126%. Now you could use this MIRR. I didn't put the reinvestment, the reinvestment rate I put down here. So the MIR, you put MIR and you select the values. Then you put the finance rate. Now that's irrelevant in this case because there's no negative. If you have multiple negative cash flows, then you have that. And then you can do the same thing here. You can say, okay, let's take this 200 multiplied by 1 plus the finance rate plus the stuff we get at the end. I'm going to do it slowly. Shift control 1 first. And then, so that gives us our 270 we get at the end. And then we take that number and divide it by the earlier number. Okay, and we get 2.7. And we take that whole number. I don't have to put these brackets, but I'm freaked out by the, and raise it to the 0.5 minus 1, and we get our 64. You can say, oh, the MIR fixes everything. It doesn't really. Because what happens, look at what happens. If you would just take this 200 and then divide by 100, we get 100% IRR. So we could take it out and get 100% IRR and go home, or we could wait and get a lower IRR. What's the right number? And this MIR is so heavily affected. If we get 0 reinvestment rate, minus 10 reinvestment rate, minus 50 reinvestment rate, then it's so heavily affected by the reinvestment rate, or if we get 100% reinvestment rate. So basically the IRR becomes a function of what reinvestment rate you want. So that doesn't work either. Don't have an answer. Now let's put our reconciliation of IRR and ROI. I know I've done this a couple of times, but I think everybody should. It's, for me, just so important. You know what I'm going to do here is, let's select this, control spacebar. Let's make them all about the same size so we don't have this horrible thing. Okay, and let's put, maybe we can put a 10, 15 year, 20 year period. 1. Alt-EIS 20, I said, didn't I? So let's say we have EBITDA. And let's say our EBITDA is, let's put 0. LTIS. Okay, and let's say we have a CapEx. And let's say our capital expenditure is 1,000. And then we have a EBITDA. Now, you know, if I put 100 here, then the IRR should be something less, and let's make this just equal to that. Shift Control R just takes you just to the end. That should, the IRR, so the project flow should be just under, not just, but under 10%, because we need to earn a 10% interest rate, and we need to pay back our capital. So that's, here we get 8%, 7.75%. If this is 880, then it'll be less, a lot less, because more of our capital goes to repay the debt. If this is 300, it'll be almost just 30%, because this, here's why it's just that high, because so much, we got such a high interest rate that these things have no value at the end. And we're just essentially getting our interest on the number. It's a little bit less, but not that much less. Now, if we made an accounting statement, we put our depreciation first. So our depreciation, let's just say it's the 100 F4 divided by, oh, don't yell at me about this. Okay. Oh, shit, I shouldn't have done that. So I thought I'm going to be consistent, okay? And then we can put our EBIT. And let's say we have no taxes and no interest, so our EBIT is just our income, okay? And I made it two kind of, let's make this 110. 110, okay? And so it's a little bit different. And now our net investment is going to be our 1,000. Now I could prove to you, and I'm, you know, if you had this is this big problem that's inherent in project finance. You're going to pay more dividends than your cash flow, because you're going to pay out the depreciation. Now, if we put ROI, okay, our ROI, and I'm going to use the beginning of the year as our EBIT divided by the last year's, Shift Control P. So we have less than 9.06 in the first year. Shift Control 7 to just make that work. Okay, but then you go to the out year and you have 120. So you have this crazy thing where the ROI changes. Now if you do a weighting, by investment, and then do a, how about before we do that, let's do a PV factor at IRR. So IRR. Okay, so we put 1 divided by 1 plus the IRR itself, raised to the period. Okay, and then you can put a PV factor weighting. Now whenever you do these weightings, you just put an equal and then divide by the sum of the whole thing. And it gives you, down here, it gives you a 1. Okay. Okay, I'll put that. And then we could do the same weighting by the investment, which we have to use the previous one, divided by the sum of the whole investment thing. Okay. And when we do that, then we can combine the weighting which is just taking this weighting times this weighting. Now when we do that, it's kind of a pain. We have to do a final weighting, okay, which just takes this divided by the sum of that. Okay, and now what we do there is then now we can put weighted average ROI, which is just the sum product of our weighting and the ROI itself. You can't do that sum product, by the way, and you get the same thing. Okay, so that's a little bit of IRR, mathematics. Okay, and the big thing is that the IRR compounds. It's this stupid compounding thing. It's not stupid, but it's this problem. This is the problem right here. This one where the reinvestment is right at the IRR itself. I can't circle that really. Okay? So let's go to our first distortion. And the distortion, and this I think comes into play when we go to some of the other ones. Oh no. Yes. Okay, now Shift Control C. I don't know what numbers I had. Now, what we're going to do is a 20-year case and we can put our life here of 50 years, 100 years, or how many times how long did I go? LDIS. LDIS. Wonderful. 100. Somebody from GE told me about that. I don't know how to do all this crap myself. Shift Control R. Okay. My job really is just repeating what other people have said, although this theory of IRR and why IRR is a crap number, but there's no replacement for IRR, so I'm not complaining about it that much, although I am. But this time I put a rate of return in, and we're going to get our target to be equal to the actual by just having a flat number. I want a growth rate. I don't think that would have much of an effect, although let's put a growth rate. Maybe it will even have a bigger effect. So let's put 3 and equal to that divided by 100, and we right click and copy this and paste it, and instead of F11, I hope F11 is your, well, I hope Shift Control R is your favorite shortcut. I don't know. Control, and we put a smaller one, and we push this down to this one, and then we can say, well, let's multiply this by 1 plus that. I have a damn range name here. How do I do this? Nope. I hate these range names. I used to be an advocate of range names, if you can believe it. This time 1 plus the the growth rates. Okay? Now, here's the issue. Okay, this is over 20 years, and of course, what I didn't do is I'll go to this one, and I multiplied this by the true at the top, so we can turn it on and off. Okay, so this is a 20-year case, and then we'll have a 50-year case. Okay, so I'll copy that one more time. This time we have to change it. Instead of F11, this is E10, Okay, and I think I got lucky because we can, that goes from 1 to 100 anyway, and then we can put it down here and change this to E17. Okay, and we can push this up. Okay, now this is what I normally do, but if you have a high IRR, the difference between the IRR in this IRR and this IRR that I put up here right now, it's a big difference, but we don't have the same cash flows. But yes, we do. So this one is wrong. So we put this one and multiply by oops. Let's put another why don't we do another switch? Okay. I'm so sick of switches. You know, there's so many more interesting things in life, and certainly in life, and even in project finance model than getting the switches right. Some people think that getting switches right is like the biggest deal or something, you know. And that's not what I wanted. All I wanted was to put equal this thing. Let's start with this thing less than or equal to the this one. Shift Control R, and then we can multiply this by this number by the true or false. And of course, I had the stupid range name in there. It's this one, okay? And then our IRR is just on the whole line. IRR on the whole line. If somebody once a really nice guy said, oh, if I put the minus and the plus here and delay the project, doesn't the IRR go down? It doesn't, okay? It's a function of when you spent the money. If it's in 10 years, 1 year, it doesn't go down. Just today, okay? So if we can see what happens if we have a higher IRR. Now we're going to try it with different target IRRs, and that's why I made this a range name. We're going to set this difference between the realized IRR and the target IRR. We're going to set this to difference, and I'll call this DIFF 1, 2, because I think I have a DIFF 1 already. Okay, DIFF2 set to 0 by changing the cash flow. Okay, and let's, as usual, whenever you have a goal seek, let's call it case 1 goal seek. Okay, and go to the data, of course, what if analysis, goal seek, set the difference to 0 by changing the cash flow. And as long as you have any kind of short-term memory left, you should be able to remember DIFF2 and CF. So you can put this one, always the first one, DIFF2, and this is CF. And in this series of videos, we are going to have a whole lot of goals. Okay, so we can insert hey shape and So I'm so angry about them stealing money, encouraging people to steal money from Africa. I'm gonna make it angry. Okay, so this happens now. If we now This is interesting. Okay. Why did I not copy this across? Did I not multiply this by this one? Oh, there wasn't a further line. Oh. So we'll have to take this one times 1 plus the growth rate times this. I'm sure you caught my error there. Okay, so there we go. And you know, there's this thing where if you press Shift Control T and Shift Control F, I don't know if you like those colors, that's all that is conditional formatting. Control T, Shift Control F. You can kind of see where the thing stops. So this is an example. That's if it, and now you can attach this macro to the little spinner boxes. Okay, so if we put a relatively low IRR, we do get a difference, 12% for 61 years. But if we put a high IRR, then the difference starts to get really small because we're discounting those future cash flows at such a low rate. Look, 61 years versus 20 years, let's make this 100 years. I should have put this, so, okay, 85 years, that's enough. Are you telling me that the IRR only goes, we get so much more cash flow and that's all it goes up by? Now, here's my solution to this, which is probably not a great solution, and what I'm going to do is a switch after I do this. I'm going to switch this one off and go to the next one. Now, let's say we have a risk-free rate. And if we have a risk-free rate, and if we take our 20 years, we can say, okay, if our cash flow we would get from a risk-free rate is just going to be PMT, and we'll put the risk-free rate in, and then we'll put the number of periods in, and then we'll put a minus on how much we're spending, or this number. So if this is, and then we can multiply that payment by how many years it takes us. So in that case, whoops. Okay. And then if you wanted to test this, you could take the NPV, but it's kind of not very exciting to take that. And then you can say, well, here's how much money I earned over and above the risk-free rate. Okay? And of course, with my stupid range name, I'm going nuts, I'm going crazy about the range name. And then you can say, well, let's take that risk premium, the NPV, at the risk-free rate of this risk premium. Didn't have to, I could have done it all. And let's see how many times this, because we've earned this enormous rate of returns, we've earned 5 times what we would have earned with the risk premium. We take this number divided by this. Okay, now if I would have put a lower IRR in, all the way down to, let's say we had 4 or 6%, then we only earn 27% more than the risk-free rate over time. That's kind of a measure, really, of what you're getting for taking risk, a much more direct measure. Nobody will ever use it. I'm not suggesting it. So if we're at 6 times now, I didn't do this. I should attach this to the macro as well. If we have a different growth rate, I don't really think that makes much of a difference. Well, yeah, it does. Okay, we can kind of see what happens with the growth rate and what happens. And now we do get a much higher IRR, but let's put our higher target IRR in, so we're back to Africa. It's again an illustration of the craziness of these high risk premiums. Let's not go that high. Let's say we need 16%, 17, 18%. Kind of like that horrible Demon website. Horrible. Okay, now we'll do the same thing, and we'll put the project life here, and this time we'll put payment. Okay, and we'll put the same risk-free rate, F4, the number of periods, F4, and a minus on our PV with F4. Oops. We didn't need a minus, excuse me. And we can multiply that one times this true, shift control R. And now we can take this one minus the amount we would have with our risk premium. We could go through all sorts of duration analysis and everything else, and then just take the net present value at the risk-free rate of all of this, and now we earn 15 times our risk-free. So even though the IRR only went up by like here 1%, the earned risk premium went up by enormous amounts. And that's the problem with compounding. It's just this IRR mathematics. That's just our very first kind of problem. I suppose we could, if we went all the way down to 0, you know, why are we still earning 6? Yes, then it kind of goes the other way. The IRR gives you almost too high a difference. Should have put a negative IRR in. But then it looks like the 85, it's almost overvaluing the long term. Okay? So that's our that's our growth rate. I don't care about that. Let's put our IRR on. Okay. I'm going to put in country risk premium, and if you don't believe me, I've got this horrible thing you do. So if we're in the United States of America, 0 risk premium. So somehow, this is such a joke. Somehow you go to Germany, which is a AAA country. Where's Germany? Okay. And then you get a risk premium. So you need to earn 6.4 versus 5.75. We can even do that. So in 6.4 so if this is 5, let's put 5 in US. Okay, so then again you get an enormous difference between you got a really big difference in the IRR too. So okay, and then if you're going to go to Germany, let's just say it's 6%. Okay, then you get 23 times versus 0.4 times if you have a really long-term project. Now let's take some of my favorite countries. I better not. What's Russia these days? 2.85 or 7? And we got an enormous difference between the methods. How about we'll take Nigeria, okay? 5.4%. So that means if it was US, we'd get about 5%, and we're going to add 5.5 to that, and I didn't put percentages in, but so let's say we get 5% here, then we get the difference, but if it's Nigeria, we get, oops, about 10%, 5 and, okay, maybe 11%. Then we get this 14%, and look at the difference between the earned risk premium on a long-term thing. And if you, so I've heard some people say, oh, in Nigeria we need 17%. Then the difference between the long-term and short-term goes very, very small. And you just need to, I think this is an important thing to understand. So this is going to be our IRR number 1. 41 minutes already, oh my gosh. I've got to go catch the tube sometime.